Hello students, welcome to Commerce World. Okay, see in this Commerce World we are dealing with all commerce related practical subjects, all commerce and management related practical subjects. In this practical subject we have a subject called as Financial Management for MBA second semester, Advanced Financial Management for BCom students and also BBM students. Today we are dealing with the cost of capital chapter. In the financial management, the most important chapter is cost of capital. What is the meaning of cost of capital? See, cost of capital refers to the expenses a company incurs in order to finance its operations and investments. That means when a company wants to operate its business, they need what? They want finance. So they get finance from different sources. They may get the finance through by equity capital. They may get the capital finance through by preference share capital. They may get finance from debt capital, debentures, or a loan from a financial institution or the banks. But how much we have to pay for the finance what we have borrowed? So in order to operate our business, we need finance. How much expenses a company incurs, in order to borrow that money or take the finance from the different sources, from the different people, that itself is called as cost of capital. Say for example, when I am starting a business, I want money, I want capital, I don't have my own capital, so I'll borrow with my friend, I'll borrow with the bank, I will issue share capital, I will issue preference share capital. See, the public will not invest their money easily. See, always public insists how much will you pay? How much will you pay in return of the money what I am lending or what I am investing? They will ask. So then the company have to give an assurance, promise that I will pay you so much percentage of return on the money which I have borrowed. That is called as a cost of capital. So the cost of capital, there are so many types of cost of capital. One is called as weighted average cost of capital. Weighted average cost of capital. What is weighted average cost of capital? It is an average cost of capital from all sources of finance. It is an average cost of capital of different sources of capital. Next is marginal cost. What is marginal cost? The extra cost incurred for an additional funds borrowed, for the additional finance borrowed. That's called as a marginal cost. What is after tax cost? See, whatever the loan we have taken by issuing debentures or by borrowing a loan from a financial institution, when we are paying expenses, interest expenses, always it is an obligation on the part of the company that company have to deduct the taxes from the source and they have to pay the rest of the money. So always for the debt, for the loan, whatever the interest expenses we are paying, we have to deduct the taxes. So such cost after deducting the tax is called as a after tax cost. Next is, what is cost of debt? Say debt is nothing but the loan borrowed by a company to finance its business for its operations or investments. So whatever the cost that we need to pay at the end of the period, at the end of the month or end of the 6 months or end of the year, that is called as a cost of debt. Next is cost of equity. See, equities are always the owners of the company. Company have to pay a portion of the profits, a share of the profits to all their equity shareholders. That share of the profits what we are distributing to the equity shareholders, that's called as a cost of equity. Next is cost of preferred stock or a preference shares. Always these preference shares are promised to pay a fixed percentage of dividend, not more than that or less than that. they would be promised to pay a fixed percentage of dividend from the profits of the company. Whatever the dividends that a company is paying to their dividend preference shareholders, that's called as a cost of preference shares. So these are the different types of cost of capital. Now we are into how to calculate cost of equity. See, in order to calculate the cost of equity, we call it as a KE. Means K is nothing but a cost, but we don't represent it as a C. We represent it as a K. KE, cost of equity, is calculated in two ways. One is cost of equity is equals to dividend divided by market price of share into 100 plus growth rate. See, sometimes if there is no growth rate is given, assume that the company paid 5 rupees of dividend and the market price of the share is 125. Tell me what is the percentage of, what is the cost of equity if you check 5 divided by 125 into 100, you get 4%. You get how much? 4%. That means the cost of equity is 4%. Suppose if the dividend is paid 10 rupees when the market price is 125 into 100, it becomes 8%. Understood? Suppose if the market price is 15 rupees and the dividend is 15 rupees and the market price is 125 rupees into 100, it becomes 12%. So that means the company is paying 12% of expenses incurred, 12% of expenses for the money borrowed by the equity shareholder, from the equity shareholder. That is how we calculate the cost of equity if the growth rate is not given. Suppose if the growth rate is continuous, like every year, the dividend growth is around 5%. Then we add 5% to this and the cost of equity becomes the 9%. If you add 5% to this, it becomes 13%. If you add 4% to this or 5% to this, it becomes 17%. Like this, when the growth rate is given. See, sometimes what happens is, when the company issue the shares, equity shares, the company incurs some issuing cost. We call it as a flotation cost. What is that issuing cost? See, issuing cost is nothing but paying the underwriting commission to the underwriters. See, when the company wants to issue the shares to the shareholders, to the public, so these underwriters will subscribe the shares on behalf of the company for the sake of commission. This commission, they have to pay. The company have to pay. When the company pay the underwriting commission, that itself is called as a flotation cost. Say, for example, in this example, if you are paying 15 rupees of dividend and market price of the equity is 125 and growth rate is 5%, assume that the company incurred 3 rupees of flotation cost. What is that? 3 rupees of flotation cost. Then we have to minus 125 minus 3. So now this becomes 15 divided by 122 into 100 plus 5. Tell me how much you get. 17.29%. So this is how we calculate the cost of equity when growth rate is not given, when growth rate is given, when growth rate and market price, dividend and flotation cost is given. How to calculate? We have calculated. So on this cost of equity, we will have some more problems. Okay guys? So in the next class, we'll understand how to calculate cost of preference shares and cost of debt. Okay? Thank you.